Microsoft products. So we'll go ahead. For those who don't know Prosperus, we're an enabler of digital transactions. What does it mean? It means that we're not a financial institution ourselves, but we give tools and technologies to other partners to launch their own applications and use cases. And what are these tools and technologies? They are basically technologies based on digital assets. So you can call them digital currencies, you can call them tokens, you can call them whatever you want. But basically, we tokenize assets and we enable their peer-to-peer exchange on a smooth, frictionless digital ecosystem, right? So we work with a lot of partners. We consider ourselves as pioneers in this space. Why I'm starting with this introduction? It's because it's important for you to know where we come from and why we are focusing on this subject. And the reason why we're focusing on this subject, you know, the CBDCs and the opportunities of growth that it would bring to whole countries, to whole economies, including Tunisia, comes from this history and this path that we've been going through. So we started in 2015. Personally, I was working in Facebook back then in Dubai, and I found out about Bitcoin and blockchain around 2013, 2014, maybe. And I saw that that's new space coming, and I wanted to jump into that space. And I'll explain why. Since that moment and this moment where we're focusing on CBDC with central banks, what happened and why this topic is important. As a matter of notice, I'm an engineer by background. I graduated in France. I had my baccalaureate in Tunisia. I graduated in France from engineering schools, and then I worked in the telecom sector for a while with France Telecom and others, and then moved to Dubai and worked with consulting firms still in the technology sector, the telecom and the technology sector, and then moved to Facebook. And coming back to the pure digital roots, you know, that's purely digital company. And as I told you, until I found out about Bitcoin and blockchain, I jumped into that space and to the entrepreneurial space as well in 2015. So Bitcoin as a starting point, CBDC as a topic of today. What's the difference and why this transformation? Basically, what we found out is, you know, in the early stages of the hype about Bitcoin, many people around 2015, 2016 said, oh, you know, the big deal is not Bitcoin, the big deal is blockchain. And why blockchain? Because the technology behind Bitcoin enables a lot of other things that can be done in ways that were not possible before. So people started working around blockchain technologies and blockchain projects, launching other blockchain platforms, other cryptocurrencies, etc. And then some other people came, that's around 2017, 2018, saying, oh, you know what? The big deal is not the blockchain. Blockchain, just one way of implementing what is called distributed ledger technologies. And they said, you know, the big deal is about DLTs, distributed ledger technologies. And that's where big firms like IBM and others started jumping on the corporate world, trying to digitize value flows and whole ecosystems in a permissioned network. So now they're using the technology not to create currencies, but to create tokens to track, you know, goods and anything else you can imagine. So, but we came to Prosperus in around 2019, 2018, 19, yeah. And we said, you know what? The big deal is not about DLT. The big deal is about digital assets. What is important is to have your assets in a digital form and being able to, you know, transact them easily, instantly, without a huge cost, without huge delays, instantly, with a seamless user experience, and preferably in a regulated way. So it's about digital assets and not really about the underlying technology, although we work a lot around the underlying technology. So what these digital assets could be. So as you understood, they could be money and a currency, whether sovereign currency like the dinar, the dollar, the euro, or non-sovereign currency, meaning that is not minted or issued by a country, like a formal government, but by another community. It could be decentralized network, like the case of Bitcoin, and many others since then. But currencies are not the only asset that can be digitized or tokenized. Real estate could be, goodwill, loyalty points, cars, goods, inventories, commodities. Your trust score, your trust level is an intangible asset. The way people trust you, around you, and in your community is an asset that can have a value and represented in the form of a digital coin. So even yourselves, every individual could be tokenized. And you see some sportsmen actually starting to do that. Pieces of art could be tokenized. And now we're going to the craze of the NFTs, etc. So back to our topic. The main point is about digital assets. But why currency in particular? Why do we need currency at the first place? I will come back to that. So I'll continue explaining our journey so that you understand this thought process behind CBDC, starting from a non-central bank currency such as Bitcoin. So as I told you, we started incorporating in Dubai in 2015. At the end of 2015, we had the first government project that was in Tunisia, by the way, to launch what is called today a stablecoin. So it was the first dinar stablecoin. Back in the days, the term was not coined, but now it's very easy to talk about stablecoins. I'll get back to that in a moment. Also, we worked a lot with the Dubai government. We launched the Dubai Blockchain Council back in the days as well. That was live in 2016. And we had our Tunisian dinar stablecoin, a mobile app launched and live for the mainstream, for everyone. It was available on the Google Play in March 2017. Since then, that app was taken down for other reasons. I can come back to those a bit later. But that was a historical moment that we achieved back then. And that work wasn't with a central bank, that was with another financial institution. So the difference between a CBDC and a stablecoin is a CBDC is issued by the central bank itself. A stablecoin is another institution comes, they take central bank money, like dollars or dinars or euros, whatever you want, they put it in a bank account, like a custody account, and then they issue the equivalent of that in a coin, in a digital coin, like Tether or USDT or many other forms of USD stable coins. And then you call that a stable coin, and it's digital asset, digital token that can flow seamlessly into the cryptocurrency space. And you have them exchanged against other cryptos in the major exchanges. So that's one example. But here it's issued by another intermediary institution, not the central bank itself. Now, the big issue is whether central banks could mint their money directly as tokens and not have an old-fashioned money and then another financial institution taking that, putting it in a bank account, in the old classical, I don't want to use the word legacy, but actually it is legacy systems. And then create another modern state-of-the-art 21st century grade kind of money. So this is where many central banks are actually currently working. And we're going to why it's important, if it's important, not what's the impact of all of that. So the Central Bank of Tunisia started looking into this opportunity and to this space as of 2017. We were part of the commission that helped them to think through this topic. We helped them to think and set up a sandbox, which was launched in December 2020. So we have one of our projects as part of that sandbox. And in February, we had another interesting use case, which is not a CBDC, but a utility token. So now we are on something different. It's not a stable coin, it's not a CBDC, it's a utility token. And that was live with a real financial institution. I will not dig into that because we focus more on the currency tokens, not utility tokens or even security tokens. But we can exchange about that later if you are interested. And finally, and most recently, we had in July 2021, the first cross-border transaction using CBDC, this time it's actual CBDC, that was between the Banque de France and the Central Bank of France and the Central Bank of Tunisia. And we had real money flowing from France to Tunisia on a new railway. It's not the legacy old-fashioned railway, but it's a new rail based on CBDC. So real digital euros flowed from France to Tunisia in July, and real money, not just fictional like specimen money or whatever. It was real money, real transaction from a person in France to a person in Tunisia. So that was the first exposure into live context to the CBDC, at least for our company and our platform. Okay, now, so what is the CBDC? Central Bank Digital Currency. In French words, and it's interesting to know that the Banque de France actually coined a French term for this, which is called, first they started with MDBC, and then they moved to MNBC. So as you can guess, MDBC stands for Monnaie Digitale de Banque Centrale. And then they didn't like it, they went with MNBC, which stands for Monnaie Numérique de Banque Centrale. So money, what is it, whether it's digital or not? But let's think about what is it? And here I think you'll be challenged about many concepts that you thought are, you are taking them as granted, but actually they shouldn't be granted at all. There are many things that you should challenge in your understanding of money, of economic transactions, and how the economic world runs, actually. And these are very deep and fundamental questions. And that's why maybe many governments don't like Bitcoin, because it's challenging this, long fiction that was established about money that nobody questions anymore. But now here it is, so open your eyes. So Mariam, if you can help me, if you can probe some people in the audience, because I'm not seeing the list. I'll keep the screen on the presentation. You can just take randomly a name and ask him what is money, please. Mariam, did you get me?
So we just pick any name and just ask what's money. Okay. Let's see. We have Iman Ayari with us.
Okay, it's random, but it's influenced randomness because I know Iman very well and she knows this space very well. Look, Iman, I will not contradict the fate. So you're picked, so please answer. But we'll take another one later, Mariam, okay. Someone who's not really familiar with this space. But Iman, go ahead, please. I don't know if you can give her the mic.
That would be Sami, who's in charge of that.
Wait a minute, I will do that.
Okay, so while Sami gives the mic to Iman, maybe you can pick someone else so we get ready, Mariam.
Iman is, voilà.
She's on. Can... Okay, go ahead, Iman.
Okay. Hi, Walid.
Hello.
Nice to meet online.
Yeah. Go ahead.
So, let's say that it's a medium to exchange in order to exchange some benefits or some services. What do you think about?
Okay, I'll get to that later. So
okay.
Let's pick another one, please, Mariam.
Let's pick Aziz Swedi, if I pronounce that right.
Up. All right. Well, okay, that's okay.
Can you guys hear me?
Yes.
Yes.
Okay. So money in my mind is a way, a mean of transaction, a mean of payments, and it also holds the value of things, the values of goods and services in a certain economy.
All right. Okay. So I see that we have a knowledgeable audience here. So thanks, Aziz and Iman.
Thanks.
And indeed, the formal definition of money sorry, where's the, yeah, so this is one example of money. So the formal definition of money is, first of all, a unit of account. How would you account for value? What is value? But that brings us to another more deeper fundamental question. What is value? But I will not open that debate today. It will take us much more time to discuss. But anyway, you can see money as being a unit of account to account for value. And then that unit could be dollars, Bitcoin, dinars, whatever. Like to have different units to account for distance, many units to account for weight, many units to account for energy, etc., etc. The second, it's a means of exchange, indeed. So it's a way to enable the exchange of value. So I give you a good or a service which has a certain value. But then there are two ways to settle that. Either you give me something else with more or less approximately the same value, which happened before money exists, which is called not tendering, which is called bartering. Yeah, that's a barter. Or I give you something else in the meantime as a means of exchange. And that's something else you can use it with someone else to get something of similar value, where the importance of the unit of account. But also it's a means of exchange. And also, as I said, it's a store of value, because in the past, I had to have another value available immediately to exchange it with you against another good or service. But here, we can store that value in time and use it later. And that's the third function of store of value. Like would store energy, so you produce energy, you store it in a battery to use it at another time when you don't have access to the actual energy source. Yes, so then what are the different forms of money? I mean, we saw this banknote. You know that in the very early history, money existed in the forms of, seashells, and then moved to gold pieces of silver, of gold, of metal, other kind of metals before gold, and then become on paper, and then the coins that we know today, the bank coins and the banknotes. Yeah, but then what are the properties of money? What qualifies for money? So Mariam, let's go for another round, please. Pick someone randomly. What are the properties of money? What can we use as money?
Let's take Bassem Mtiba.
All right, so Sami, if you can enable the mic, please. What can we use as money? What properties that should the interest have to qualify as money?
It's already, je dirais, enabled the mic.
Ah, he can't respond. He's in the middle of a workspace.
Okay.
Perhaps.
We can take Donia Travelsi, maybe.
I think you can speak in French too, if you want, Walid.
Yeah, Donia, if you're, it's easier for you in French, you can go ahead. Huh? So what qualifies as money? What can you use as money? What properties should an instrument have to be used as money?
Okay, I think we lost her. Maybe you try with Firas
Did we lose her
Masmoudi.
or did we scare her? Okay.
Firas Masmoudi, I don't know if you can hear us.
Go ahead, Firas.
Perhaps they are in the office.
Okay, so it seems that it's not very, very easy to have an interactive session. So I'll go ahead. All right. So the properties of money are mainly the following. First, it has to be divisible. If you want to use it as a unit of account, let's say half of a chicken, Okay, if you want to account for the value of half of a chicken, the money or the means of exchange should be divisible into, what is worth half of a chicken. I don't know what it is exactly, but it has to be divisible, so we can use it as a unit of account so that we can account for any amount of value we want. So that's number one. And why I'm saying this, because if you remember early in the days of bartering, if I have to use a cow as something to exchange for a chicken with you, maybe you can give me a chicken, but then how much of the cow I have to give you? Not easy to say. But if I'm using milk to exchange with you and have to give you half of a cup of the milk, then that's possible. It's easy to divide milk. It's not very easy to divide a cow. So that's the first thing. Second thing, it has to be transportable. If I have to use it as a means of exchange, so if I'm away from my home and I want to buy something from you, I'm walking around, I go by the river, I find you got a fish. You were fishing and you got a fish. So I want to take your fish, but I need to have something else with me. So if I have to go back home to get my container of milk or my cow or my eggs, it's difficult. So I need to have something transportable with me. And that's when people started using, seashells and then other metals, etc., etc. And then back in the days, when the Chinese were trading with Europeans, and at that time we were using gold as money, they found it very, very hard to transport gold, big amounts of gold, because these are traders. They fill up whole boats with goods to move them from Europe to Asia, etc. So you need big amounts of gold, and it's heavy. So it's not easy to transport. Plus the risk, if you have issues along the road, you have pirates, you have things like that, it can be stolen. It's risky. So it's not easily transportable. And that's where they started using the paper as a paper note, saying, I give you this paper with a guarantee that I can give you this gold when you give me that paper. And that was the equivalent of the first banknote. The third thing is it has to be durable. Because as we said, if you want to use it as a store of value, you sell a good today, you get money for it. And let's say you want to use that as savings to spend it when you are retired to buy food. But if you get something, you want to use it 20 years later, if we're getting a chicken, a milk, or an egg, good luck using it in 20 years' time or trying to exchange it again for something else in 20 years' time. It's not durable. But the gold is, and other forms are. So these are the key properties of money. So which brings us, if we fast forward, to the usage of gold as money, which remained the standard of unit of account, means of exchange, and store of value for a long, long time in history, until the US removed the peg to the gold standard after the Second World War, and the unpeg of the dollar from the gold. And that's where we have money as we know it today, with its issues as well. Okay, so what are the issues that money brought? We thought of money as being the solution to everything, but actually money has a lot of problems and brings a lot of problems. So what are the money problems? I'm sure that everyone has money problems. Okay, we'll not make it complex to go into an interactive session. So let's go through them very quickly. So money has been used more and more as a standard mean of exchange and fueling the global commerce and economic activity. However, it has the cost of being non-inclusive, and proof is, even in the 21st century, so many people are excluded from the modern financial system and from the economic equation as a whole, which is a pity, honestly. Second, it has low accessibility. To have money today, you need to be close to a bank, to a bank branch, to an ATM, to somewhere where you can get cash, etc. Not everywhere, especially in remote areas. So today, with modern digital tools, you can access that probably easily through, a mobile app. If you have internet in the middle of the forest, but still, you can have that in some advanced countries, but maybe not in countries where you have not so advanced banking infrastructure like in Tunisia. It has costs, and actually it has a lot of costs. The cost of payment, if you go to a restaurant and try to settle a bill using a bank card, so they would take around 2.5% to charge you for that transaction. And that's one of the reasons why restaurants or merchants, they tell you, oh, the machine is down. Not because the machine is down, but most likely because they don't want to use that as a means of exchange. They wanted to give them cash because it doesn't have the 3% cost. And you know, for a business, 3% on the overall turnover is huge. It's like maybe around 30% of their profit if they make 10% margin. So the cost is actually very huge. Not even talking about cross-border. If you're trying to send money between countries, you can be charged up to 8%. You imagine what that means. Someone who works very hard all the year to try to send money back home to his family is being away from them all that time to be able to build that value, accumulate that value, store it into somewhere, and be able to send it. And in that process, he loses 8% of it. Can you imagine? 8% for a taxi driver in Dubai to send his money to, I don't know, to the Philippines is 1 month of work. You know, you work 12 months and you have to put away 1 month just to cover the cost of sending that money to someone else. It's huge and nonsense. Of course, it also has delays. Sometimes it takes a day, sometimes it takes 48 hours. If it's cross-border, it may take up to a week. I remember one time I was in Dubai sending money to my sister who was studying in Canada. It actually took 3 weeks. And here we're talking Dubai and Canada, like really advanced countries. We're not talking, you know, other, I don't want to use negative words, but, you know, other really non-advanced countries. And of course, it has risks. If you use your card, you can be hacked, you can be charged back. If you're a merchant, you are not sure that you got final settlement for your goods, the bank can ask you back for that money to tell you, oh, the card was stolen, and it wasn't a legitimate transaction, a lot of issues. So then you have insurance and you have to pay for insurance, really a lot of issues and risks. And we know that happens all the time. And then finally, a lack of sophistication. I can give you money, that's the most stupid action that can happen, that's it. But you cannot have a smart algorithm. I give you money if you give me something. I give you money at that specific time of the month, of the year. This versus that, what we call if-then statements, which takes us to smart contracts, which are today enabled through you know, digital money on platforms like Ethereum and others. And this enables a whole bunch of new cases that were not possible with the traditional money that we know, even if it's digital and sits on bank accounts and on IT systems. So what is this new form of digital money that we need? So ideally, it should be affordable. It should be real time, that can happen at the speed of the internet, like the expectation we have from anything that happens in our daily life today. Instantaneous, just with a click of a button, boom, at the speed of light, at the speed of internet. It has to be secure. If you look at Bitcoin, regardless of the issues that you have at the edges with exchanges and other traditional players like the banks and others, in the pure Bitcoin space, there's no Bitcoin that was hacked. Even though it's public, there's no firewall, no data center, the blockchain is open to everyone. To all the Russian hackers, to the Chinese hackers, nobody could steal Bitcoin from one person to another person in an illegitimate way. Now it can happen with other ways, but not really cracking the blockchain itself, right? Whereas, you know, in bank accounts, even with the all sophisticated tech they have and the IT systems, you can still steal money from bank accounts, and many pirates actually manage to do that today. But nobody manages to steal Bitcoins from the blockchain. Unless they fool you, they steal your private key, etc. But you cannot hack the blockchain itself. So that's security. Smart, as I mentioned, being able to do programmable rules to define how we want to exchange that value, actually, etc., etc. Ideally, it should be universal as well, be able to manage it from anywhere, from any place, anytime. through any device, as I said, as a mobile, through a mobile in the middle of the forest. That's the ideal form of money I would like to have. And available to everyone anywhere. So peer-to-peer over the internet and instantaneous and secure. So basically these are characteristics and properties that would be needed in a form of digital money. Forget about the gold, forget about traditional banknotes and bank coins. This is what we would want in a digital form of money. So why is a digital form of money very important? Because it enables economic growth. If it's easier to transact, if it's faster to transact, and here we're linking to our today's topic, what is the potential of CBDC for the economic growth? And it doesn't matter if it's CBDC, non-CBDC, if it's money, not money, digital, not digital, but at the end of the day, what do we care about? We're caring about the economic opportunity and driving economic growth. So here's a very interesting study. If you reduce the transaction cost for any exchange, and remember, we said it's a means of exchange, but when you exchange value, what is that? That's value creation. Every transaction that happens, every exchange that happens between Iman and Aziz, between Mariam and Sami, etc. Every exchange is value creation, and that builds toward the GDP. The GDP being the aggregate amount of value that was created by everyone in that system, or in that group. So, if you reduce the transaction cost by, I think they calculated by just 0.1% in the transaction cost, you can quadruple the country's output. It may sound astonishing, but think of it. Why this huge leverage from 0.1 to 4 times, like 400%? That's about 4,000% factor. 400. Why? Because if you look at the overall economy, each piece of good probably goes through many, many exchanges. So if you think of value chains to get, you know, I don't know, a box of biscuits, to get to the box of biscuit, imagine all the value chain that was involved to get the finalized packaged good, from getting the milk, from getting the flour, from transporting it, from the guy getting the truck, from the guy in the truck putting oil and gas in his truck, and imagine what was required to bring that gas and to transform it, and then everything, getting the paper, getting the, you know, a lot of things, getting the electricity for the plant to manufacture the biscuit. So many transactions involved. So that cost of transaction compounded at every time. Imagine you pay 2% at each transaction. Imagine this, you pay 2% at each transaction. So to get to the end of the product, at the end of the value chain, maybe you went through 20 transactions. So it doesn't count for 40% because it's compounded, of course, with the amounts of value that goes from one step to the other along the value chain, but still, it's a huge cost. Imagine you remove all that, how faster and efficient things would be. And think of it really mechanically, Imagine you have an engine in your car, and imagine you have something that is creating friction in your engine. So every time your engine has to make one round, it has to go through 20% resistance. How fast would your car go? And how far your car could go? So imagine if you remove all that friction, and suddenly you feel the engine really released and go much faster and much smoother, right? This is reality, this is mechanical reality. Think of electricity. Imagine if you want to take electricity from your battery to the lamp. Imagine that from each room it crosses, it goes through 20% loss. How much light will you get at the end of the road? I mean, you might see, you might be able to read the text, but you know, you would have lost a lot. Imagine if you remove all that friction, how much lighter and brighter the room would be. So that's a real problem we are tackling. And that's why it's important to have money in a digital form in the 21st century. And we estimate this to be, speaking of economic opportunity, if you do all the calculations, if you enable all sectors with digital money, and you remove all that friction that exists with the legacy money, that can amount to 7% of GDP. 7%. Can you imagine that? Like 7% of GDP could come out of this loss being brought by all these inefficiencies behind money and behind transactions. All right, so let's move on to this famous CBDC, central bank digital currency. If you can imagine a system whereby digitally you can enable instant, secure, frictionless, and low-cost peer-to-peer value exchange, wouldn't be a wonderful thing? My answer would be yes, based on all what we saw. So, what is a CBDC? I mean, you can say it's digital money, yes, but more precisely. So this is the definition of the BIS, the Bank of International Settlement, which is the central bank of the central banks. You know, every country has a central bank, and all the central banks, like you have the UN for countries and for governments, you have the BIS for the central banks. So the central bank of central banks. And they are working on these topics like very seriously in the past couple of years, and many banks and central banks are accelerating their work on this topic. And here they come on a formal definition on their own website. So according to the BIS, a central bank digital currency would be a digital banknote, like the one that I showed you at the very beginning, the 1 dinar banknote. So it's the same thing, except that it's digital. I know maybe many of you are wondering, yes, but money, most of it, 80% of the money is already digital. It's sitting on banks, accounts, and IT systems, etc. Maybe we still have some physical money, but if you look at yourself, your own net worth or your own balance, I don't know how much money you have, each of you, but I'm sure most of it is not physical. Some of it is physical in your pockets and in your closet and in your drawer, but many of it is non-digital, probably in a bank account or somewhere else, on Bitcoin wallet, whatever you want, but most of it is non-digital. So here, what does it mean to have a digital banknote? I'll get back to that a little bit later as well. So it could be used by individuals to pay businesses, shops, or each other, which is called a retail CBDC, or between financial institutions to settle trades in financial markets, or which is called a wholesale CBDC. I'll get back, if you have time, to the difference between retail CBDC and wholesale CBDC. So why would we need a CBDC? What would we use it for? And why central banks are looking into this? And again, this is from the BIS official definition. The CBDCs could ensure that as economies go digital, which I was saying a bit earlier, the general public, I insist on this word, the general public, would retain access to the safest form of money, a claim on a central bank. So each word here matters, actually. This could promote diversity in payment options, make cross-border payments faster and cheaper, increase financial inclusion, and possibly facilitate fiscal transfers in times of economic crisis, such as a pandemic. Remember the helicopter money that was distributed by, advanced governments like the US and Europe to its population? Just distributing money instantly, immediately, to everyone in the country, like they did. With these means, it would be much faster and easier. Okay, so here I go back to the statement of retain access to the safest form of money. And here they say a claim on a central bank. Well, we can agree or disagree with that statement. If a claim on a central bank is the safest form of liability, at least it used to be that way. But again, let's look at traditional environments. Who can you turn to if you have an issue? If you have a peer-to-peer transaction and something goes wrong? Who can you turn into? Nobody. Or maybe you can turn to a judge, to a court, which is the government, and then the government, the government money. If you want the ultimate trust in the government, then the central bank is the government. In this case, the statement is true. If you turn to something else, like let's say Bitcoin, is it safe, not safe? Can you lose it, not lose it? Depending on where you store your money in your wallet. Who's the wallet provider? Do you trust that software company? Will they steal your keys, etc.? Is it safe or not? I mean, it's fair to assume that it's not that safe. Depends on which brands you work with, etc., etc. And different brands earn their trust? Would you trust Google? You trust Google because Google maybe earned that trust if you keep your emails with Google, and if you keep your photos, very intimate family photos with Facebook, etc., etc. But here they're saying the safest form is with the government, with the central bank. We can take time to discuss this statement, but that's what it is for now, right? So why do we need central money? And does money have to be central or not? If you go back to the beginning of the discussion, if you want a means of exchange, a unit of account, and a store of value that is divisible, transportable, and durable, okay, if you have that instrument, it doesn't matter if it's centralized or decentralized. If some people found a way to bring that in a decentralized manner, why do we need to have central money? And here again, we get to another philosophical debate. It will take us so much time to go into the intricacies of this specific discussion. But let's say you might have decentralized money. You might have centralized money in traditional form, like banknotes, paper banknotes, physical banknotes, and bank coins. And fiduciary money, scriptural money, like balances on bank accounts. But again, this balance on the bank account is not a direct claim on the central bank. It's a claim on that bank, but that bank can go bankrupt. But the reason why it's safe or relatively safe is the central bank is overseeing this and making sure that your bank doesn't go bankrupt and you don't lose your money. Is it fair enough? I don't know. When you look at 2008, where governments were supposed to make sure that banks don't do things that go wrong, well, they failed. Lehman Brothers, 2008, and global economic collapse. That's when the Bitcoin white paper was published. Direct answer to that. So, even if you have your banks at your money at the bank, it's not that safe. Okay, now there's insurance, etc., etc. But look at what happened in Greece. Okay, the whole country went bankrupt. Even if banks can't give you your balance, can give you your money, even if it's insured by the government, and the government cannot hold to that claim and to that promise because they're overexposed. Maybe they can cover the loss of one bank, but if you lose with the 20 banks, nobody can cover that insurance. You lose your money. And that happened in many countries, actually. That happens in many countries. Zimbabwe, Argentina, many. So a claim on a government money is not necessarily safe. And this is the philosophical debate between, the decentralized agenda versus the centralized agenda, whatever, but that's a different discussion. But let's assume we still have to live in countries, in communities, with regulations, to do these exchanges we talk about for goods and services in a regulated way, where we can have a claim to a court, to justice, to dispute resolution, etc. And we still need the government as part of it. Then if the government has to give us money, it's better to be digital money. Let's be honest about that, and not paper notes and metallic coins. All right. So that's why central banks are exploring this, and this is part of their mandate. Central banks are exploring whether CBDC could help them to achieve their public good objectives. So this is the mandate of a central bank, to achieve public good objectives such as safeguarding public trust in money, maintaining price stability, and ensuring safe and resilient payment systems and infrastructure. And really, this is the mandate of a central bank. Now, whether they succeed or not, it's a different story, but at least this is their mandate. Who has that mandate for Ethereum? Who has that mandate for Bitcoin? Maybe other forms of governance, maybe other forms of social contracts between the participants of the system. But here, at least we have a formal way of ensuring this in the context of regulated environments of governments and of CBDCs. So let's face the reality that we're going into a tokenized world. And the economy as we see it, and we talked about, like exchanging milk and chicken and whatever, and goods and services, will become a tokenized economy. What is a tokenized economy? I wish we could have the participation of the audience, but it's not very easy. So I'll just keep running with my own monologue. Everything will be tokenized, really. And every object, every asset will be a coin by itself. So if we can come back to the discussion, will we have one currency or multiple currencies? If you think about it, If you want a unit of account, a means of exchange, and a store of value, why would you need 180 currencies? Why would you need a yen and a won and a euro and a franc and a dinar and a dirham and a dollar, and why? Why not just one unit of account, which is a means of exchange and a store of value? It's a complicated discussion. I want to go back to that. At some point, there was one standard, which is gold. It's not there anymore. And now you have Bitcoin and Ethereum, and you have 1,500 other currencies. Do you need one? Do you need many? And if many, how many you need? My answer is you need as many as assets that you have. Each asset will be its own currency in a way. But this is fast forward in the future. It's not today, but that's what we envision for the future. And in that future, you wouldn't need a central money anyway, like an intermediary of exchange between these tokens, because all these assets will be tokenized anyway. They can be exchanged in real time, frictionless, at low cost, peer-to-peer. They can be divisible, they can be durable, and they can be everything that we said, right? So each asset can become money, and you don't need another intermediary like we needed in the legacy world. So this transformation is happening, and it's happening fast. And I like this example, like how transformations can take us by storm. So read these three statements. In the last decade, 40% of the Fortune 500 companies were wiped out. Hear that. These are Fortune 500 companies. 40% were wiped out. Not they declined, not they reduced their business, they were wiped out, simply. And in the 21st century, change is happening even faster when you look at adoption cycles of TV, telecommunication network, mass media, broadcasting, electricity, electric goods, electric engines, oil brand engines, steam engines, internet, satellites, everything. The adoption cycles are going faster and faster. So you can bet that this cycle will even be faster. And if you look at legacy versus new, for Deutsche Bank and Binance, these are old numbers, by the way. These date back to 2018, I guess. Today, they will be much, much more different. And, it goes without words. How many branches you need to run Deutsche Bank, how many employees, how many years in business, and how many profits they can generate out of that. And Binance, you look at the contrast. So this is the power of digital money. Now, Binance is about cryptos, decentralized cryptos. So what about fiat money or traditional money that is run by banks like Deutsche Bank? How can you make that world more efficient? The answer would be by bringing digital central bank currency. If you have that, it will be able to exchange goods and services in a tokenized way, and you can estimate that over $500 trillion worth of value will flow in the form of digital tokens. If we just look at the NFT craze, the pieces of art, look how much value is already exchanged in digital tokens. And you can imagine that that's the early signs of everything else going digital in the future. You can take my bet on this. And that's what we are preparing. And that's why we're laying the infrastructure and the foundations behind this. So let's go back to the fiat money or the government money as the main means of exchange. If you look at money and how much money we have in the world, so these are just some examples. We estimate that the amount of money in the world is about 7 trillion. Again, this is an old slide. It's virtually impossible to keep track of this because it moves so fast. So I gave up updating it, but at least it gives you the order of magnitude of things. Yeah. And now, so the physical cash that we know is about $8 trillion. Tunisia would have roughly $100 billion in cash in circulation. And crypto would amount to, I don't know, that moves so fast. Maybe that changed. Maybe it's 3 trillion now. I don't know, but it keeps moving so fast. Yeah. So the reason here is even if crypto went up, it's still a small fraction of the overall world economy when it comes to actual money and currency. So if you digitize Tunisia's money, will you be able to run a more efficient economy? The answer is yes. But should you digitize only cash and money? And money has different forms, M1, M2, you know, broad money, narrow money. I will not get into that. These are the macroeconomics of monetary policy. We don't have enough time to go into this, but imagine if you digitize all stock markets, all debt, all real estate, and all the goods, what's the value that is involved? And if that value can be exchanged instantly in a frictionless manner without all this huge cost that you have. I gave an example of normal payment into a restaurant or into peer-to-peer cost transfer to a student. But let's say you want to buy stock. Imagine the cost of the transaction if you want to buy some equity in some company, and the paperwork and the registrations and the accountant and the lawyer and the qbada and the whatever and the stamps and the paper and the fees and I don't know, maybe it's 10%, 20% of the value of the transaction. I don't know, it's huge. The cost of doing a real estate transaction is huge. Imagine if all these markets become more liquid, we will run a much better economy. So this is a new operating system we need to have. This is what can be built with central banks. It can be built without central banks if they don't want to, but I think they understood the message. So many of them are actually jumping into this road, are running their own projects to build, you know, a CBDC. The impact of it, and I'll try to wrap up here because we're almost at the end of our time. The impact would be estimated for cases like Tunisia at around 7%. I can break that down for you. We don't have enough money, time, sorry, and time is money. So if you look at the transaction that happened in Tunisia, around 200 billion dinars of annual transactions. Most of it happens without efficient digital channels. These are happening with physical cash, most of it. More than 50% is happening in physical cash. The rest is happening through the banking system. And imagine all the pain you can have in the banking system, etc., etc. This will change. I mean, if you introduce a digital money into the system, you will make this economic engine much, much efficient, more efficient and faster. And here you have the costs of using physical cash and storing money and counting money and losing money and all the issues. Here you can have the cost of it. So it's around 0.5% of GDP in an advanced country like the US. So if you take a cash-based economy like Tunisia, multiply that by how much cash you have in the US versus total GDP and how much cash you have in Tunisia versus total GDP. And then you can have your ratio if you assume a linear regression, right? So it's around 3% of direct cost. So 3% of direct cost of actual physical money cost in the economy, and all the indirect costs of all the hindered opportunities, transactions not made, payments not made, e-commerce not made, goods and services not made, jobs not created, etc., because of this. If you don't have a transaction, you don't have economy, you don't have business, right? We agree on that. So if you don't, a means to facilitate the transaction doesn't happen. If the transaction doesn't happen, that's a lost economic opportunity. And that's roughly another 4% of the GDP. So that's what it means, cumulative 7% of GDP. All right, so here you can see the breakdown of how the transactions are happening in today's world. You see in this list, you don't have the CBDC, but if you introduce the CBDC in the mix, maybe you can have a more efficient picture. And finally, we close with the case of remittance, which is another opportunity for Tunisia. Imagine all the money flowing to Tunisia with remittance, with all the pain and cost taken by the inefficient means and channels. If you reduce that friction, I'm guessing you have much more remittance flowing into Tunisia and still fueling the economy. And remittance went up by 30% in the last year, by the way, probably fueled by COVID, many people sending more money to their families, etc. So imagine if they could do it in an easier way. And that's, again, goes with the line of the experiment we did with the Banque de France. Then we have a more efficient economy. So if you get rid of all the inefficiency of these old physical systems and with the paper cash, you can create a more efficient economy. I'll skip the numbers here, but I think you get the picture. We wrap up with this one. So many central banks and governments, I think they got the message. Many of them are experimenting with CBDC, and some of them actually launched already, and more will join the wagon in the next couple of years. And that's where is the core of our activity right now at Prosperus. So what is the opportunity for Tunisia? I would say more inflows, like we saw in the remittances, and other cross-border transactions. It will happen much easier. People who would like to work for foreign companies like freelancers, they don't have to finally go and use Bitcoin and go to jail if they want to create an economic activity, right? More integration in global digital commerce. Global commerce is going more and more digital. And Tunisia will be more integrated into that system if it can have its own digital currency to enable all these flows and exchanges and transactions between these stakeholders, involving Tunisian stakeholders and Tunisian companies, Tunisian businesses, and Tunisian jobs. More efficient economy, as we saw, up to 7% of GDP. That can be the magnitude of the impact. And then having champion tech players. If Tunisia keeps working as a pioneer in this space, then probably can create tech champions who can then export this technology to the rest of the world, and not have Tunisia, again, like for all the other historical revolutions, becoming an importer of technology from other countries. We import steam engines, we import trucks, we import power plants, we import anything you can imagine, because we didn't build that know-how on that industry. And we import internet routers, we import everything, computers, laptops. So let's not miss this wave of being an exporter of technology when it comes to digital transactions platform. At least that's what we're trying to work on. So these are key opportunities, I think, and I'll stop here.